Hello.
Hey, Mike. How are you?
I'm good. I'm good. Good. And you?
Good.
All right.
Well, yeah, share my screen.
You're a little grainy today. Oh,
Yep.
there you go. Now you're clearing up. All right, everybody. Welcome to Lumber Futures from the Free Seats.
Hola.
Uh,
Um, yeah, so we have lumber can finally go up here. It's not all one directional, finally.
well,
Uh,
it's the tale of two markets, though. Like the cash
yeah,
market is
yeah.
just, from what we can tell, just kind of laying there.
No, it's to watch January expire at 344, to watch that Jan March spread trade out to negative 90 plus, to see the mini Jan trade in that 400 area. I know West Fraser came on today, the week of 123 out of Alberta at 354. I guess Tulco came on at 345 today. I'm hearing some of the other mills with some lesser tallies, sub 340. So watching futures, you're certainly, I like to say I'm seeing signs of cash catch fire here, but when you just look at Western SPF 2x4 prices, it's a slogfest out there, and futures is futures, and cash is cash. And when you look at March versus cash right now, they're certainly not meshing up.
And then you can, aside from the Western SPF market, you can take a look at the East Coast and see the Euro, 2x4 16-foot Euro, no wane premium product. It's 450 all up and down the coast.
Yeah, no, I think, and I had put this out in my commentary on Friday, that this is a big inflection point for cash, where you're going to have to see, to support these numbers in March. And we know that, look, the funds can do whatever they want to do, and they're probably the catalyst to drive this market higher. But to really support this wholeheartedly, you're going to have to see cash engage here. And look, to say that March belongs at 440 and cash belongs at 345, 355. I mean, I would think that by the end of this week, you're really going to need to see cash up in this 375, 385 plus, if not higher, to substantiate this move in March. If not, then at one point, one's going to call the other one out here.
Well, the markets are never wrong, because
Right.
they are what they are. And we are at, I think I bring this up every time we're at this stage of the life cycle of the contract, which is, this is the longest duration between when the front month contract is away from its expiration. So
yeah, and that's kind of the easy answer. Is, as much as I don't understand the disconnect today, outside of the funds, I mean, March, if you're on the buy side of March here, realistically, this is April 1st to the third week of April wood. And what you're buying from the mills today is probably the middle of February, and or sooner if it's coming out of the east. So you just have that timing disconnect. And I mean, seasonally, we're kind of marching toward the, when the markets peak out into the third week of February. Historically speaking, and I know Matt had asked about this, historically speaking, what does a market do when the front month goes off $90 under the next month out? And that's a good question. That's something we'll have to do research on. Historically speaking, when you throw out kind of the last 2 years and just look at lumber pre 2020, typically when you have these gaps on the continuation charts, you don't necessarily have to fill the gap completely. So Jan expired at 344. You don't necessarily have to go fill that gap immediately, but typically a market the next month out will trade within 2 to 5% sooner rather than later. So, are we going to leave this 344 gap there forever? I find that hard to believe. But that being said, we're within, when I look at March today, the high at 448, we're within striking distance of the November expiration at 450, 480. So we still have that gap out there. So, we're kind of surrounded by gaps to the upside, a gap to the downside. And again, for me to be a believer in futures above and beyond just short covering with the funds, and we'll get into the CFTC open interest type stuff, but you got to see cash engage, and you can't have mills going up $4 a thousand, a day or a week and say that this makes sense. At some point, this you're going to see more acceleration in cash, or ultimately futures comes back down to some kind of more meaningful basis, and at four, cash at $355. I mean, historically, your basis should be somewhere in this 20 to $30 range. And right now you've got, what, $80, $90 a thousand in basis.
Okay. All right, let's jump into it. Let's see what's driving this thing.
So we'll jump. I think the one thing that jumped out on this is that you can see interest rates, treasury markets are forecasting that the or that the Fed is not only done with you're getting closer to terminal Fed funds rate, but the treasury curve is suggesting that rates will start to come back down on the Fed funds rate by the end of the year. And you're seeing this more reactionary in the middle of the curve, the 10-year and even the 30-year. So I think that this is interesting. You see a bottoming here of rates, and the higher this number goes. So this is 4.5%. This is 3.5%. So rates are suggesting, when you look at where we could float back to, maybe a 3.25%, 3% on the 10-year. So when I look at this, you could see you have rates peak out here. You make a bottom in the NASDAQ, you make a bottom in the S&P, you make a bottom in the Dow. So the markets like the idea, regardless of what the Fed is telling us, that, okay, rates are starting to pull back here. And maybe this means something for lumber here, where okay, and when we get into, here's the 10-year at 3.51. A week ago, this was 3.66. So can the 10-year work its way back into 3%? And then when you roll it out,
hang on, back up just a second on that one. I mean, you go back to November, October, we were over 4.
Right.
Actually, the beginning of the year, we were, scraping 4.
Yeah. And this is, with housing starts ahead. So we have housing starts and permits on Thursday. Unfortunately, I think they're going to be pretty bad numbers. It's going to be very difficult to surprise to the upside on starts, just because you're going to reflect the time period where 10-year rates were above 4% and the 30-year was above 7.5%. So there's going to be some rough numbers ahead for housing here. You got to get through this, but then you've had this pullback now in the 30-year rate, and so again, the market seems to kind of suggest that, okay, rates are going to conceivably improve. And you're starting to see this with equities now, where the NASDAQ's up today. NASDAQ is more rate reliant. The Dow's still down 350, S&P's unchanged. But this is I trade the S&P here, and this is a major inflection point where you're either going to fail, and you can barely see it, but this yellow line is the 200-day moving average. So if you can break out above the 200-day, then that would portend a bigger move up to 4,100 to 4,200 in the S&P. If you fail, then you could roll over pretty dramatically back down to sub 3,900 on the S&P. And the reason I'm bringing this up here is the markets are going to get some Fed news this week. Last week, Powell said Fed might have to make unpopular decisions to stabilize prices. We will not be a climate policymaker, so we're going to do things that are politically deemed incorrect. And so with equities and rates kind of deviating from what the Fed wants, the thing that I'm looking for here, tomorrow we have the Beige Book commentary. On Thursday, Lial Brainerd speaks, and she's really good. Is she going to toe the line? And then on Friday, Fed Governor Christopher Waller speaks. So what does the Fed want here? And the markets are going to react. Does the Fed, watching interest rates kind of deviate from what they're telling the markets, do they try to rein this back in, or are they going to, it's going to be very interesting to see if the equity markets can rally given the Fed speaking this week. I think these 3 days are going to be pretty critical as far as what equities do the rest of the week.
And if you take a step back from the equity market, look at big picture, we're kind of going nowhere. We've basically stopped going down. We're kind of more in a sideways trend than anything.
Yeah, and
I'll bet it's a big, wide swinging trend or sideways move. It's by no means are we in what we've experienced for the last 20 years of, essentially a bull market or just
no,
uptrend.
and again, you're seeing it, Mike, with bank earnings. I mean, J.P. Morgan was out last week, Bank of America, Goldman Sachs was out today. I think this is the first time Goldman missed earnings in like a decade. So the environment isn't positive even for the banks, where you don't want your banks making money off of interest income. That's not why banks exist. They make money off of the deals, transactions, business deals, and you're just not seeing that in this environment right now. So, again, that goes back to the Fed owns all these assets in the form of securities. They're in liquidation mode. Your PE is in a declining structure. So, again, the market through interest rates can kind of tell us what they think the Fed is ultimately going to do. But so far, the Fed has been very adamant in what they actually want to do. And it'll be interesting to see this week if they continue to toe that line or not. Because if they don't, you could have a big breakout in equities to the upside. And we'll see how badly the Fed wants to see something like that. Because then the other thing is when we get into the other commodities, you've had a big move higher in gold and copper. You've had a bigger move now in crude, and the forecast for crude oil are to go back above $100 to $110. And even lumber is trying to get off the mat here, where, does this mean anything, especially when when the Fed is trying to control inflation and see the metrics that suggest that inflation is beginning to show signs of being in check. So here's commodities, lumber. We're finally in the green, up 15% over the last 5 days. You can see the energy markets are up. So you've had a nice run in physical commodities here. And even the S&P is on this list. The NASDAQ's on this list. So commodities are higher here. And is this what the Fed wants to see? Pure and simple, does the Fed want to see assets rally here, appreciate? Is that a slap in the face when they're telling you that they're trying to stamp out inflation? Losers, I think the only one that really jumps out here is VIX. So here's your sideway. No news is bad, or no bad news, or no news is good news, where from a volatility standpoint, volatility is extremely low in the equity markets right now. So probability of a recession in the next 12 months is kind of trying to peak out in the 60% threshold area. Most economists still think we're going to have a minor recession, whether you have a soft landing to be determined. And so, the big numbers last week were CPI. We have PPI tomorrow. And so here's your forecast for inflation now. You can see a year ago, this was the forecast, a little bit off. And then here's the forecast as we start to moderate, that we're back into, a year from now, we're kind of back into that Fed's target of 2.5% to 3% inflation.
I'm sorry, back up. What's the source on that?
This is a Bloomberg economist survey.
Okay.
Yeah. So it's just your top 40 some economists.
The Fed's forecast is a little higher than that, I think, correct?
Yeah. And so that's the disconnect, is that you have economists that are trying to read the tea leaves. The Fed is coming out and they're pretty adamant in trying to say what they're going to do. And you've got this disconnect between economists out there and really between treasuries. When you look at the yield curve is really saying something completely different than what the Fed is saying right now. That rates that you could get to terminal Fed fund rate, and then you could pivot off there by the end of the year, where the Fed so far has adamantly said, no, that's not the case. We're going to go to terminal, and we could politically incorrect, politically undesirable, stay at that rate a lot longer than people think. So somewhere in between lies the truth. And again, this is why I think it's critical this week when the Fed govs speak. What do they actually say? And watching all these things play out. And when you jump into inflation, the thing that I saw this week is that we're mimicking what we did in the 70s and 80s. How you had this big zenith, this big crescendo higher, like an Eiffel Tower formation, and then you retraced immediately. And could you get something like that? And there's some thought, among some of the economists out there that we could be deflationary by the end of the year, where this inflation isn't real. It was all supply driven, and once everything cleans itself up, you could collapse a lot faster back into that Fed terminal rate for inflation. And so I'm not going to spend too much time on this, but this gives a good perspective of here's inflation pre-pandemic, here's inflation now. And this kind of breaks it out by category. So you can still see that, yeah, inflation is falling, but you're a long way from that target of where we were pre-pandemic. There's a lot of work to do in the metrics that the Fed watches to suggest that they did what they wanted to do in stamping out inflation. And so when you take out shelter, so here's rent growth. Okay, this is, can you just simply remove shelter from the inflation dynamic here? And you want to see a big reversal here with rent inflation. And then, okay, here's median home price inflation. So we've stopped going up, but we're by no means are we negative. We've just gone back to kind of going sideways now. And more importantly, median home price growth has stopped going higher here. But are you seeing that clawback with existing homes now? Are you seeing actual prices pull back where you're seeing a big decline in home prices to incentivize people to buy existing homes, regardless of rates? Are you getting, does it make sense to buy an existing home now because you're getting a price break?
North of the border, we see it. Canada,
Yeah, yeah.
they've effectively done it. And I was reading today, Zillow says new homes may be the value.
Yeah, no, and that's kind of, I'll jump through this, but here's inflation broken out. So I'm not going to spend too much time on this, but water, sewer, trash collection, you're still higher than pre-pandemic levels. Transportation is dramatically higher. And you know this if you've flown as of late, still significantly higher than pre-pandemic levels. Recreation is still higher. Medical care is actually cheaper. Um, and then you get into education and communication, kind of the same. Other personal services. So again, this is excluding shelter. You're still higher. So again, these are all things that are from the Federal Reserve. These are all things that the Fed looks at to say that, yeah, we're having an impact on inflation. And you want to see continuous consecutive months of negative growth in all of these different metrics to say that inflation is actually under control. And so, getting into housing, Mike, I thought this was great. So this shows you different mortgage rates and home price of $450,000, what your mortgage payment would be, and the number of households that can afford a house. So at 3.22%, where we were a year ago, 44 million people could afford this house. Today, that number drops to 26,000 or 26 million people. I mean, you have a 14% decrease year over year of who can afford, and you can extrapolate this out. This is an income distribution, so you need to see inflation being reined in so people have more money, or you need to see wage growth so people have more money. There's no secret how people are going to buy homes. It's either lower rates or making more money to do it. And so from a rate standpoint, yeah, you want to see, if you could get back to 5.22%, you could create another 10 million people that could afford a $450,000 house. So, rates are critical here, and then income is critical. And I showed this last week, but when you look at personal savings, look at where we're at versus now versus the onset of the pandemic. Look at credit cards now versus where you were during the pandemic. People have less money. So if there's less savings, interest rates are higher. Well, you need to increase people's savings through higher wage growth, and you need to lower interest rates. Pure and simple. So, I mean, here's real average hourly earnings change from a year ago. So at least you're coming off the bottom, but when you factor in inflation, people are still having a negative impact on their wages. Inflation is still taking money out of your pocket versus where you were. You're still losing 2%. At least it's not 4 or 6%, but you're still a net loser from an inflationary standpoint when you factor in all the goods and services that are impacted by inflation. So, again, there are bright spots, interest rates. I think just looking technically, again, you could see 30-year mortgage rates fall back to 6%. You could see the 10-year fall back to that 3.25%, 3%, which would be good. And then inventory of homes on the market, we're really not seeing a big build. There's still a shortage of homes out there. That's a positive thing. And kind of what you alluded to, Mike, maybe that bodes well for new homes, where if you don't have an inventory of existing homes on the market, then that's the incentive to keep building homes because there's an actual need for new homes.
Well, and we've talked about it in the past. If you've got a cheap mortgage on your house, why would you give that up? Unfortunately, the mortgages are not transitory. They don't move with you. They stay with whatever that house was. And if you sell that house, that mortgage is gone, and now you're buying back in at a higher interest rate.
Yeah, no, I think, unfortunately, you're moving because you have to move because of family issues or because you're getting transferred. But to move for the sake of moving, that's going to be easier said than done. And look, the one positive thing is that if I'm buying a house, I probably have the mindset right now that in 2 to 3 years, as rates do pull back more meaningfully, I can always refinance.
Yep.
But you have to be able to qualify for that loan, and more importantly, you have to be able to afford it. And that's going to be easier said than done, probably through Q1 of this year. So then the other really positive thing, here's building material year over year cost changes, and this is a sight for sore eyes, in that you are seeing, again, year over year, significant changes now, not just only in lumber, framing lumber, but everything else, and that you're starting to see inflation bled out of just everything that goes into building a house. So, that being said, you should start to see builders incentivize as they get a pullback in their building costs. You should hopefully see this transfer over to the home buyer, where you can incentivize people to buy homes now. Skip. So weekly continuation, we'll jump into lumber here. January expired at 344. The contract low was 342. We didn't quite make it down to the March expiration level of 2230, but again, that was the cheapest expiration since March of 2020.
Okay.
And we're like we talked about, March today got up to 448. So here's March, and you're kind of bumping up into. I'm sorry. Here's November expiration. So you're kind of seeing March try to bump up and fill this November expiration gap at 450, 480. And so here's your breakout on the weekly now. Does this mean anything? Does this push more funds out of the way? But this is your weekly continuation. And just by virtue of Jan going off and March being the front month, you are trying to break out of this coil triangle formation here. And then so on a monthly continuation, the positive, we're holding the 200-month moving average. That's this yellow line here at 370. So the market is trying to hold that and begin to show signs of, can we bottom out here? Is this good enough? At least we're trying to do that here on a consecutive monthly basis now. January expiration, again, 344. Here's March, obviously a big disconnect. Technically speaking, you broke out above the Bollinger Band high, and you have higher highs, higher lows. So this is the pattern until it's no longer the pattern. And the upside objective now in March, this is the 100-day moving average in the 457 area. So that's your next upside objective in March. Above there, again, you would fill that November expiration gap. Above there, you're talking the 480 to 490 area, technically speaking. Here's that Jan-March spread. Again, it had actually traded negative $92. So somebody was able to buy January, take delivery or EFP Jan with the Western SPF sawmill and sell March at $90 over. And you could do that at even better spread levels, conceivably today, with cash still being in that 355 and March being up another $10 today. Here's March, May. The one thing that's interesting here is initially this spread narrowed into a negative 20, negative 30 cents area. The last 2 days, it has not been able to narrow. It's actually trying to widen back out, where last trade is now negative 510. So that's unusual that March is kind of taken off to the upside, but you're getting May as a sympathy trade where you would have thought that March would have gone maybe to this even money to 2 over area on May, but it's actually widening. So I'm not sure, I'm all ears what that means, if it means anything, but you're not seeing a narrowing of that spread. It's actually trying to widen back out.
Yeah, that's something I definitely keep my eye on. Just relative strength of that front month. We're up $10 today. We're off the lows. It's, probably almost $100 move, but these moves get exhausted. So you start looking for some ancillary indicators. Is that move run its course? And one of the first places to look is the spread market. How is it performing relative to the other expirations?
Yeah, and again, when I look at March here, again, you've had 7 up days in a row now. Again, when this buying stops, the industry is not going to be buying this premium to cash. Cash is your best buy. You either want to sell the board against cash from a basis standpoint, or you're just going to, I just want to be long cash. I don't see a lot of risk. But this is your commodity fund. This is your speculative liquidation. When this stops, my whole point is, and look, you could go to some dramatically higher number if the funds have more to liquidate. But when this stops, there better be a fundamental justification for March to be at this kind of premium to cash. And at the very least, you could see a fallback. This is this blue line right here is your 44-day moving average. This blue line right here is your 9-day moving average. This is your 20-day moving average. So technically speaking, look, cash might float up to 360, 365 at some point when this does top out. You could see March trade back down in this 408 to 390 area and kind of normalize that basis at some point.
Right. And, to keep the funds coming back and buying back their shorts, we have to continue going higher. Like the funds need a trigger to their trade.
Right.
So anything sideways or down is not going to trigger the funds to cover.
We'll come back to, but here's your basis. Here's Jan's from last week. This is March, and this was as of the close. So this is another $10 higher. So you're at a $98 basis. Again, normalized basis would be somewhere around $20. So this doesn't make a lot of sense. Same thing in May. You're at an $94 basis as of right now. Historically speaking, again, here's the onset of the pandemic. You had these wild moves up and down basis wise, but take the pandemic out of the equation and just look at kind of where basis trades. So history shows that in a normalized market, and I should have, I have a long-term version of this, but you can see a $50 basis is pretty extreme in a normalized market pre-pandemic. Here we are. And again, this doesn't do, I think this is January right here. but we're literally in this $90 area. So, oh, sorry. This is a pretty extreme basis for $350 wood. It doesn't make a lot of sense.
And it's, the basis trade itself, it's a simple trade, but it takes time. It's if you're an impatient cook and you're not supposed to open the oven on a souffle, this is that kind of trade. You can't.
I like that. Yeah, no, I mean, look, if your basis trading rolling wood and you need a desto on it, then that's
You're
not a
not
basis
basis
trade.
trading.
That's speculation. If you have to make money on the short side of futures, that's not a basis trade. That's a speculative trade. If you're going to basis trade this, you put the wood on the ground, you incur the margin calls on futures going up against you, and you like you said, you're the cook, the patient cook that comes back a month from now. This probably looks a lot different, maybe next week. But to say that this has to react, the immediacy of this, no, it doesn't. You could go on another month where you have major distortions until you get into the time frame where you get the convergence one way or the other.
Yeah, to
And
successfully basis trade, you have to have the flexibility and the liquidity.
yeah, and that's why basis trading is not for everybody. It's not a blanket trade. So from an open interest standpoint, there's still a big chunk of Jans that have to be EFP'd off, and you'll see that. And I'll have the updated EFP numbers. I didn't have a chance to update, Alex. I didn't have a chance to update the EFP chart. We'll have that next week. But the high water mark is about 3,200. We're down to 2,856. Obviously, these Jans are going to go away. So, to say that it's obviously all funds just get liquidated out of this market, well, I'm sure that that's the case, but they are being replaced by, not necessarily one-to-one, obviously, but you are seeing fund liquidation get replaced by either new longs or new shorts taking their place. And so, this is the interesting thing. This is as of January 10th, last Tuesday. This is kind of pre-rally or the onset of the rally in futures. The funds actually added 140 contracts to their position. Now, you did see longs. So, my question is, obviously this number should be lower when we see it this coming Friday, but do you have new funds that are going long lumber now? Do you have another segment of funds that wanted to get long lumber? Maybe this isn't all short covering. Maybe that there's an equal or greater fund out there that wants to get long lumber. So that's something to watch. And then the other thing you're likely to see, as you see this report a week from now, this number will realistically decrease because of the premium to cash. And does this number start to increase more dramatically? Where do the mills start to sell this big basis to where they're selling physical cash right now? If the mills really wanted higher numbers, you would sell March, take that wood off the market, reload it. It's off the, like we just sold a week's worth of work. Sit on the wood. The wood goes away and let the convergence take place, and hope that selling March at $400, $450, wherever it is wrong. And a month from now, you're covering it $200 higher. But just think what that would do to stabilize physical cash prices and the returns you would get on 80, 90, 95% of your physical cash. But this is the thing to watch for me. As these guys liquidate, do they get replaced by these longs, and do they get replaced by these shorts? Does this number increase? Does this number increase as this number decreases? And that's kind of what we want to see on Friday when the next report comes out.
Yeah, I was pretty surprised when I saw that 140 increase. And then I thought about it, and you look back, and yeah, there was still more opportunity back then for the shorts to get in and actually do okay.
Yeah, and again, I know, there's some questions, and again, these are all opinions, but the funds that I speak with aren't necessarily concerned about having to roll into the mini contract. It is what it is. It's a cost of doing business. I think the funds are more influenced by technical indicators and fundamental indicators, and those will continue to be the driving forces for fund longs, fund shorts, if they're going to continue to trade lumber futures.
Something that's kind of perking up on my radar, and I was listening to Bloomberg about it today, the China situation.
Mm-hmm.
Of course, the United States and Canada are big drivers of the overall global lumber market, but um, we have in the past seen China as a massive consumer of fiber, and they've essentially been out of the market um, for North American for sure, like they were 5, 6, 7 years ago. Um, but they're not roaring back as fast as kind of I think everyone expected them, the
Yeah,
economy to.
they had their I think GDP was out yesterday, and it was like 3.5%, which was their slowest growth rate in, I want to say, decades. And then the other interesting thing, I don't know if you saw this, but population
I was just going to say that. Yeah.
is declining, which is crazy.
Yeah.
You know,
China declined. I think India surpassed them as the most populous country.
yeah, no, and COVID, the onslaught of COVID running through them now, that population decrease really was still with the zero COVID policy in place. So, uh, it's that number is not likely to grow anytime soon. For years, they conditioned their population. You can only have one kid, and you literally condition generations of people. Well, we're going to have one kid, and as the economy grew, and you could move out of the farm into the city and have truly a middle class life, enjoy life, not just the necessities of life, but some of the luxuries. You've conditioned the younger generations. We're having one kid, or we're not having kids.
Yeah.
We're going to enjoy life.
The I always look at the market, and we sit here and we talk about the knowns. This China information is the known. What generally drives the market is the unknown. So I'm trying to figure out what I think could. I'm trying to learn what the unknown is right now.
Mike, let me share the screen. 1 minute. I'm going to show you.
Sure.
Am I still sharing? I'll
Yep,
show
there
you
you
this. You'll like this. So the world's wealth broken down, and look at the two 800-pound gorillas here.
Wow.
Here's everybody else. The wealthiest. Your G7, your G20 nations, the U.S., China. You want to talk about kind of what's to come. Can China keep clawing away and push this to the other side? But this tells you everything that you need to know. Everybody else is playing in our sandbox between the U.S. and China.
That's amazing. I had no idea. So yeah, I think maybe an unknown is China not roaring back, and what that would do. Uh, we've said it for probably the last 8 months that this market is in control of the supply side, meaning they're driving it. Demand is not outpacing what they can make, so they need to right size to keep the market from going to zero.
Yeah.
And until that happens, we're going to be in the doldrums.
So the next thing that I would look at, Canfor announced their pulp mill closure in Prince George last
Yeah.
week.
Yep.
You can kind of do the backwards math, and that pulp is obviously supplied by chips. Chips are a byproduct of dimensional lumber. So what mills supply that Prince George pulp mill? What mills are currently on one shift in BC? And I would think that you're going to see more shutdowns sooner rather than later within BC. And you just look to those mills that are on one shift right now, or legitimately the mills that supply the pulp mills, and you can do the backwards math to figure out that there are more shutdowns coming out of BC, permanent shutdowns. This is one of probably there's probably another 2, 3, 4 dominoes that have to fall sooner rather than later in BC as a result.
Yep. So I think that's the long term is looking for the what's going to drive the big picture. Short term, I just shake my head every day and look at this basis trade and say, what an incredible opportunity. You have to know what you're doing, but there's no better time than this to actually put one on, and you can screw up kind of bad and still make out just
yeah.
fine.
And if anybody has any questions or even wants to paper trade it, we're more than happy to just kind of educate people and walk them through so they can comprehend. Again, we talk about it. Basis is just simply cash minus futures. and you've got an interesting anomaly right now for again, we've come out of $1,000, $800 wood where the basis should be dramatically higher. The basis you have today should equate probably to $700 to $800 wood. Well, you have $350 wood. This is a really good basis opportunity depending upon what kind of cash you use. So, I'm more than happy to spend time with people. Again, you don't necessarily have to do it, but you should at least understand it for future use.
And, if you think about if a mill came to you and said, I want to do a vendor managed inventory, I want to fill your yard up with wood so you have it at your disposal at all times. That's basically what you can do right now is you can fill your yard up with wood that's sold. It's just sitting there waiting for this basis to come together. And you can pick from it as long as you continually replacing it, right? So it's a great opportunity to have on-hand wood that you can use or have at your disposal. You have to replace it immediately, but it's this is an amazing opportunity. All in.
Yeah, no, that's it. That's all. Looking forward to next week. And like I said, I'll have updated EFP numbers next week, and then we'll have housing starts in the books. We'll have PPI in the books. And then we'll have market's reaction to the two Fed govs that are speaking this week.
Perfect. All right, everyone. Thanks for tuning in, and we'll talk to you next week.
Thanks, Mike. Thank you, everybody.
We'll see where the basis is at next week.
Yeah, sounds good. Thank you. Take care.
Bye.
Bye.